Welcome back to the deep dive. Today, we're taking a plunge into the colorful, always shifting world of India's paints and coatings industry.
That's right.
And our focus, one of the really big players, Berger Paints India Ltd, and we're looking at their latest financial pulse check.
Exactly. So, our mission for this deep dive is, well, to unpack Berger Paints Q1 FY26 financial results. We've really gone through the whole stack, investor presentations, the financial statements, press releases, even the earnings call transcript,
The full works.
pretty much, trying to pull out the most important nuggets of insight for you.
Okay, so before we dive into the numbers themselves, maybe for anyone newer to this space, who exactly is Berger Paints? What's their standing, in this pretty competitive market?
Well, they're a major force, definitely one of India's leading paint, coatings, and waterproofing companies. They're actually ranked among the top 15 coating companies globally.
Top 15, wow.
Yeah, and they've got a really widespread presence, not just across India, but also operating in Nepal and Europe, either directly or through their subsidiaries.
And it's not just about size, is it? They have a reputation for innovation, too.
Absolutely, they've been real pioneers in the Indian paint market. Think about their tinting systems back in the day,
Right.
allowing for custom colors, groundbreaking stuff then.
Right.
And products like Easy Clean, Weather Coat, Anti-Dust, they're basically household names now. They even innovated with services like express painting using automated tools. And importantly, they hold a really strong leadership position in some specialized areas too, like protective coatings and general industrial coatings here in India.
Okay, that sets the stage really nicely. So turning to Q1 FY26, what's the big picture for Berger Paints? What were the main headlines that sort of jumped out at you first?
I think the overarching story really for Bergen in Q1 is just their continued consistent market share gain. Despite all the heavy competition we hear about,
Oh,
they've actually pushed their estimated market share to around 21.2% among the listed companies. That's based on their standalone results. It's a really clear sign they're not just holding their own, but actively gaining ground, consistently doing better than the industry average.
that is a strong position to be in. Now, on the volume side, they reported mid-single-digit growth. Specifically, what was it, 5.6% standalone volume growth?
That's right, 5.6%.
Sounds solid enough, but was there anything holding back maybe an even stronger performance there?
There was, unfortunately, a pretty significant moderating factor, which was the heavier than expected monsoon. It hit early May and June.
Ah, the weather.
Yeah. Sales in the paint industry, they're pretty seasonal, right? Often get postponed during heavy rain. And that early heavy rain definitely put a damper on what could have been even stronger numbers for the quarter, a key external challenge they had to navigate.
Makes sense. Yet despite that, they actually managed to improve their PBDIT margins, both sequentially and year on year, even with what management called heavy competitive pressures.
Indeed. It really speaks to their operational resilience, I think.
Which segments, if any, really shone through for them in that environment?
Well, the automotive segment, for instance, delivered stronger volume and value growth compared to the main decorative segment. So pretty robust demand there.
Okay.
And their international operations also showed very strong revenue growth, which definitely helped the consolidated picture.
Right. So to really unpack this, we need to get into the raw financials. How did all this translate into their top and bottom lines, looking at both, say, standalone and consolidated figures?
Okay, let's break it down. So for revenue from operations, standalone figures show 2,862.62 crores. That's a 2.0% increase year on year.
Modest.
Just 2%. Okay, yeah. On a consolidated basis, which includes their subsidiaries and JVs, revenue was 3,200.76 crores, which is up 3.6% YoY. A bit better.
And profit, before all the deductions, PBDIT or EBITDA.
Right, PBDIT. Standalone was 499.49 crores. That's a 3.3% increase YoY. Consolidated PBDIT came in at 528.41 crores, which was actually only a 1.1% increase YoY. So, again, modest but positive growth in operating profit overall.
But then, hang on, we see a pretty noticeable dip when we get to the net profit, the PAT. Standalone PAT was 293.76 crores, down 3.8% YoY. And consolidated PAT saw an even bigger drop, 11.0%, down to 315.04 crores. What's the story behind that drop right at the bottom line?
Yes, this is where we hit what's called an exceptional item. There's a really significant impact on their net profit there. a 36.81 crore exceptional loss.
Okay. Due to what?
It was due to a fire incident in one of their warehouses in Barasat, West Bengal. Now, what's really crucial to understand here is that the fire didn't actually start on their property.
Oh, really?
No, it originated at another company's place nearby and then spread to Berger's warehouse. So the loss is mainly related to damaged inventory and some fixed assets. But importantly, the company is already in the process of filing an insurance claim.
So it was insured.
Fully insured, yes. So while it hits the P&L this quarter, it was essentially a one-off external event. It doesn't reflect their core operational performance.
That really does change the interpretation of that net profit figure then.
Okay.
It's not some systemic issue, just an unfortunate, isolated event. Good clarification. So moving to margins, we heard gross margins stayed pretty stable, right? Hovering between 39% and 41%.
That's right.
Q1 FY26 came in at 40.1%, which is actually up from Q1 last year, but a slight dip from the previous quarter, Q4 FY25. What caused that little sequential dip?
Yeah, management pointed to an adverse product mix for that slight QOQ dip, and it ties back really to those excessive rains we were just talking about.
Oh, okay. How so?
Well, heavier rain means less demand for exterior emulsions naturally, and they also saw a bit of a decrease in sales of their luxury interior emulsions, so that shifted the overall product mix slightly towards some lower margin products for the quarter.
Right. Makes sense.
But the overall PBDIT margin resilience, as you noted earlier, was quite strong, despite that mix effect. And that was driven not just by the stable gross margins, but also by good operating leverage from fixed costs. They seem to have actively controlled and reduced those.
Good cost management, then.
Yes, and also improved utilization finally starting to come through from their Sandila plant. That plant had been a bit of a drag initially when it started up, so seeing better utilization there is a positive.
Okay. Sounds like they're managing the controllables well. Let's shift gears a bit and look at how their different segments performed and maybe what new innovations they're bringing out, because Berger is clearly not standing still here. Starting with the big one, the decorative segment.
Right, decorative. It delivered that mid-single-digit volume growth we mentioned. The good news here, I think, is that the gap between volume growth and value growth narrowed.
Why is that significant?
Well, it suggests an improved product mix overall, and maybe the impact of earlier price corrections is finally waning. They also saw really strong traction in specific, more differentiated products, things like Roof Cool and Seal, their Home Shield range, that's their construction chemicals arm, and also their wood coatings. These often command better margins.
And beyond just the products, they're also heavily focused on expanding their actual reach, aren't they? What's happening with their retail network and those famous tinting machines?
Exactly. Big focus on physical presence. During this quarter alone, they added over 300 new stores. That brings their total count now to more than 1,300 stores.
300 in a quarter. That's quite something.
It is. And a strong push on the tinting machines, too. Over 2,500 installed just this quarter. And they're aiming for over 10,000 more for the full year. It really underscores their commitment to reaching more customers directly and, providing those customized color solutions right there in the store.
And on the product innovation front, they've definitely been busy. They introduced Color Plus, right? A new interior premium emulsion matte finish. How does this fit into what they already offer? What's special about it?
Yeah, Color Plus seems quite smart strategically. It's designed specifically to complement their existing flagship, Easy Clean, which, as you know, has a bit of a shine to it.
Right.
So Color Plus offers that premium matte finish, uses European technology, they say, it's washable, and comes with a pretty impressive 6-year warranty. It was initially launched down south, but now they're expanding it. Fills a specific niche for people who prefer that matte look, but don't want to compromise on durability.
Okay. And they also rolled out Luxol Metallics. What's the appeal there?
Luxol Metallics is a new solvent-based metallic range. Comes in silver, gold, copper. Offers that, lustrous metallic sheen. It's PU enriched, so should be durable, and comes with a 4-year warranty. It really caters to that growing trend for more decorative, specialized finishes inside homes.
And building on their successful Cool series, they highlighted Anti-Dust Cool, Roof Cool and Seal, and a new one, Tank Cool, specifically for water tanks.
Yes, Tank Cool.
Reducing indoor temperatures by 8–10 degrees C, that sounds like a powerful value proposition, especially in a hot climate like India.
It absolutely is. These products use technology to offer really tangible benefits, particularly crucial during those hot summer months. It provides a clear differentiator for them in a very competitive market. Real problem solving.
Definitely. Okay, let's move over to the industrial segment now. Protective coatings, automotive coatings, how did that side of the business perform?
Well, the industrial segment overall maintained positive volume momentum, which is good to see. However, their general industrial, or GI, and their powder coatings performance remained somewhat subdued. Management partly attributed this to ongoing issues in the fan industry, which is a key end-user market for these types of coatings.
Right, specific end market issue
Yeah.
there. And construction chemicals and waterproofing. We've heard about strong traction there before. Did that continue?
Yes, absolutely. This segment continued its robust volume and value growth, and with stable margins too. Specifically, they called out Roof Cool and Seal again, saying it continued its momentum. It's really a testament to the strong underlying demand for good waterproofing and those heat-reflective solutions.
Okay. Now, when we look at the consolidated picture, taking in the subsidiaries and joint ventures, that also tells quite an interesting story, doesn't it? Which ones really stood out and maybe which ones faced some headwinds?
Yeah, quite a mix. BJ and Nepal really outperformed within the group, delivered strong revenue growth and also margin expansion. So that shows the strength of their regional operations.
Good news from Nepal, then.
Definitely. Then you have Bolix, which is their UK operation. Now, it reported stable revenue in constant currency, which is, positive given the UK economy. But its UK operations specifically saw muted margins, and that impacted the overall Bolix group profitability.
Why were the margins muted at Bolix UK? What was the issue there?
It seems it was due to the nature of some long tenure projects they were working on. Costs, especially because of time delays apparently caused by regulatory issues, kind of got ahead of the revenue recognition.
Ah, project timing issues.
Exactly. But despite these sort of short-term margin pressures, Bolix remains strategically quite important for Berger, especially with its focus on energy-saving initiatives in Europe and the UK, which is obviously a growing market concern there.
Right. Makes sense. Meanwhile, you mentioned STP and SBL coatings saw sort of flattish growth and weighed on profitability.
Yeah, they mentioned scale challenges that were weighing things down a bit.
Yeah.
But it wasn't all headwinds in the JVs.
Okay, who are the stars then in that portfolio?
Well, Berger Rock, that's their auto refinish joint venture with Japan's Rock Paints, continued to post really solid performance. Both revenue and profitability were strong there.
Good.
And their other auto JV, BNPA, that's Berger Nippon Paint Automotive Coatings, also delivered robust growth in revenue and profits. Apparently driven by higher OEM sales, they mentioned Kia specifically as a big account.
Okay, strong auto performance then.
Yes. And even the Becker JV, another one, witnessed a strong turnaround after some fire-related losses they'd had previously, helped by an improved product mix and margin recovery. So yeah, lots of moving parts across the group, but definitely many positive contributions offsetting some of the challenges.
That's a really comprehensive look at the numbers and the different segments. It does raise an important question, though. How are they actually navigating this competitive landscape? We know it's intense. And what's their outlook for demand going forward? Management confirmed competitiveness remains high, right?
Correct. Very much so. And this is where some of the management commentary from the earnings call gets really insightful, I think, particularly regarding the new entrant everyone talks about.
Ah, yes, the big disruption story. What did they say?
Well, they stated quite plainly that the initial euphoria among dealers regarding this new player has, and I quote, completely gone.
Wow, completely gone. That's strong. Wow.
Apparently, dealers are now realizing their own profit margins are getting squeezed. There's increased inter-dealer competition because of the new player's tactics, and this has led to, again, their words, a loss of interest from dealers towards the new player. They might be swinging back towards the legacy companies.
That is a powerful statement. So, does it suggest that the aggressive tactics the new entrant used initially might not be sustainable in the long run?
It certainly seems to imply that. And there's some evidence, too. News seems to indicate that the 10% extra grammage offer the new player had, it's being rationalized. Now it's apparently mainly just for the big 20-liter packs.
Not the smaller ones.
The 1-liter and 4-liter packs have potentially been withdrawn in many markets, according to the commentary. It kind of underscores how difficult it might be to sustain disruption just through aggressive pricing, without those deep-rooted relationships and brand loyalty.
What about painters and influencers? Are they shifting?
Management noted it's still hard work for any new entrant to win them over. They didn't observe any significant ebbing of support for legacy brands or any great enthusiasm for the new one among that group either. Still a relationship game.
And are these competitive pressures felt sort of uniformly across India? Or are there regional differences?
Not entirely uniform, no. They mentioned competitive intensity is slightly higher down south, and the impact seems to be felt more towards the economy end of the market. Primers, basic emulsions, the more commodity-like segments, rather than in the luxury or premium segments, which seem more resilient.
Okay. Shifting focus slightly to demand recovery. What's the outlook there? We heard about the monsoon impact earlier, dampening Q1.
Right. Well, management expects sales to come back once the monsoon fully abates. The thinking is that paint sales are typically postponed by rain, not lost forever.
Right.
So their expectation, once the rains properly stop, is for maybe high single-digit volume growth in the coming quarters.
High single digits. That would be a good recovery.
Yeah. And it's also worth noting, they pointed out that for the first time in 5 quarters, the listed players collectively showed positive industry volume growth, albeit small at 0.3%. When you factor in the new entrance volume, the overall industry growth is probably around 6.5% currently.
That feels like a positive turning point, even if small for the listed players alone. Because if we connect this back, last year's value growth was hit hard, wasn't it, by that 5-6% price drop across the board and maybe a 3.5% share shift to the new players.
Exactly. So the underlying demand might have been stronger than the raw value growth numbers suggested back then. They also mentioned seeing a broader slowdown, maybe 3-4%, in consumer sentiment across many categories, not just paint due to inflation, but that this seems to be progressively improving now.
Okay, so what are the positive indicators they're watching for a more sustained recovery? What gives them confidence?
They mentioned a few things, just a gradual improvement in demand overall, some early momentum kicking in, particularly in urban markets. The monsoon, while disruptive early, is now progressing well, which should help rural sentiment. Easing inflation is also a positive factor, especially for rural areas, and potentially a pickup in government infrastructure spending in the second half of FY26. All these things could create a more favorable environment.
What about that volume value gap we talked about earlier? Is that expected to stick around?
They think a differential, maybe 1.52%, between volume and value growth will probably persist for a while. It's mainly because faster growth is happening in high volume, but lower value products right now, think texture coatings, tile adhesives, things like that. But they do expect the gap to narrow over time as the product mix continues to improve.
Okay. And just quickly on cost management, employee expenses showed double-digit growth. What's driving that? Is it just salary hikes?
It's a combination, they explained. Partly, it is normal salary inflation, which historically for them averages around 8-9%. But critically, it's also because they've been genuinely adding feet on the street.
Right, hiring more people.
Exactly. Especially investing in urban markets, putting salespeople on the ground there for future impact. So it's a strategic investment cost as well as inflation. Advertising and promotion expenses also increased, but generally in line with, or maybe slightly higher than, sales growth, around 4-5%. So continued investment in brand building and market presence there too.
So putting it all together, what's the management's overall strategy amidst all these dynamics? The competition, the weather, the demand shifts. How are they planning to, win in the long run?
Well, their core strategy seems pretty consistent, actually. The company is deliberately maintaining a stable price level.
Not getting drawn into price wars.
Apparently not. They seem to believe it's a better long-term strategy than just reacting aggressively to discounting by new entrants. Their view, based on history, they say, is that new players often end up withdrawing those initial aggressive benefits over time, and sales eventually swing back to the established companies with the strong brands and distribution networks.
So it's a strategy of strategic patience combined with that focus on innovation and making their brand distinct.
Precisely. Their continued big push is on innovation. We saw the new products and building that brand distinctiveness to navigate these short-term challenges. And of course, they're keeping a very close eye on the key external risk factors, things like currency volatility, any ongoing tariff wars, and just the general evolving geopolitical tensions. These can always impact their international operations and, crucially, their raw material costs.
Okay. So as we wrap up this deep dive, it feels like the key takeaway is Berger Paints showcasing really strong market share gains and a lot of operational resilience, despite those external challenges like the heavy monsoon and the intense competitive pressures.
Absolutely. And while their net profit definitely took a hit on paper, it's so crucial for you listening to remember that one-off fire incident was officially an exceptional item, not an operational failing.
And fully insured.
Fully insured, and they're working on the claim. It really highlights why sometimes you need to look beyond just that final bottom line number to get the full picture of how a company is really doing.
Totally agree. And we are seeing those positive signs of demand potentially recovering, coupled with their clear strategic focus on product innovation and continuing that retail network expansion. It paints, pardon the pun, a pretty compelling picture of an established leader adapting and actually strengthening its position.
So maybe a final thought to leave you with. As you consider this ever-evolving market, particularly in industries like paints, what do these results from Berger's maybe tell us about the long-term impact of new player disruption versus the deep-rooted resilience and strategic patience of established industry leaders like Berger? Something to think about.